Hello, I'm David Frazier, the founder and president of Investors Monitor. In this introductory video, we're going to tell you a little bit about our company and our internet website, and most importantly, how you can use the information provided at this site to avoid the big downturns in the financial markets, to profit from the major upturns, and to invest in the right sectors at the right time. I began by making a very important statement, that being, we do not consider ourselves a financial news site. Even though we do report on recent events, which is the definition of news, that is reporting on recent events, we consider ourselves to be a financial market information site much more than a news site. And that we say that primarily because the news media in general tends to focus on emotional-based, interesting stories. I mean, you'll hear on broadcast news shows on a daily basis, for example, of how here's the latest story. Well, we don't strive to tell people interesting, emotional-based stories. Rather, we focus on significant factors and developments that are likely to affect the worldwide financial markets, and more importantly, that are very likely to affect the value of your financial market investments. So, in just a moment, we're going to tell you more about our website and a little bit of information about ourselves. And I think, and I'm very confident actually, that those of you that watch and listen to this entire video, which by the way is probably going to be about 50 minutes in length. So it's a long video, and you might think, wow, does it really need to be that long? And our answer is we think it does need to be, because we have a lot to cover. And the reason being because there's a lot of information provided at our site. But I am very confident that if you watch and listen to this video, and then you use on a regular basis the information that we provide at our site and in our related publications, that you will begin to avoid the big downturns in the financial markets, to profit from the major upturns, and to invest in the right sectors at the right time. So let's get started. Okay, let's begin by just looking at the name of our internet website, Investors Monitor. Well, why is that the name of the site? Why did we choose that as the name of the site? And it's really, really simple. Because what we strive to do here at Investors Monitor is to provide you with everything that you need to know, but nothing more, to help you to monitor significant developments in the financial markets, in the worldwide economy, geopolitical developments, corporate earnings, factors and developments that are likely to affect the value of your financial market portfolio. So, here we have a site where you can do just that. You can monitor all of these factors and developments. So hence our name, Investors Monitor. Now, what's this little sign over here to the left, this logo sign, and this burgundy colored little blocks and this black sign? Well, those of you that are mathematicians will recognize really quickly that that is an integral sign. And so why do we have an integral sign for our logo? Why? Because the integral sign is a sign that relates to integrated factors, and that's what we provide on our website and through our publications. We provide important information on various factors and developments that affect the financial markets, and we show you how all of those factors and developments are integrated. In order to analyze properly significant developments in the worldwide financial markets and to forecast accurately the future direction of securities prices, one needs to understand the ways in which numerous different factors and developments that affect the markets are related. That is, the way in which the factors and developments are integrated. So that's why we chose an integral sign as our logo. So now I'm going to get right into the factors and developments that we cover on a regular basis at our website, and to show you once again how you can use all of the information provided at our site to avoid the big downturns in the financial markets, profit from the major upturns, and invest in the right sectors at the right time. So let's first go to our well, actually, I was going to go to this red color, burgundy color menu bar, but first let me mention really quickly. On the gold color upper bar, there's information about ourselves, who we are and what we do, what makes us different, our historical forecast. There's information on our team, that team being myself and my partner primarily, Robert Mayer, but also on strategic partners that we have, including John Brown and Dennis May, and there's information about myself and our team here on this page, our team. Then our research methodology. I mean, you can click on that and print out and review exactly our entire process and how we go about recommending which asset classes and sectors of the market that we recommend investing and speculating in during different stages of the business cycle. Now, let's go back to our home page. And let me say now that we use a very top-down approach to deciding which sectors, industries, and individual securities to invest and speculate on at any point in time. Now, there are those folks out there, contrary or different, that use a different process. They refer to themselves as bottom-up investors. And most of these bottom-up investors often like to tell you how that's a superior process as opposed to using a top-down approach. And here's what we have to say about those bottom-up investors. And there are some very good ones, so we're not trying to knock them, by the way. But here's what I encourage you to do. Anyone or any firm that considers themselves to be a bottom-up investors, and just by bottom-up investing, meaning they tend not to look, at least not nearly as much, at economic and geopolitical developments, but just to focus on individual companies, and that's how they decide on what to invest. Well, I encourage you to, anyone that tries to tell you or that claims that that's a superior approach, take a look at their investment performance records during big down years in the market, during 1973 to 74, during certain periods from 1980 to 1982, during 1990, from 2000 to October of 2003, and during October 2007 to March 2009, the most recent bear market. See how they do in those periods, and you're going to find out that they perform very poorly. So we use a top-down approach. And what we provide, first of all, on our site, the home page is very important. And of course, you're watching a video. You're not watching this video that I'm pointing to at the moment, but you're of course watching the video on how to use our site to improve your investment performance results. We have this sign-up form here that you can sign up for our weekly commentary that we provide absolutely 100% for free for a certain period of time, and you do not need to give us any credit card information to get on. You just give us your name and email. But so let's go down to our top-down approach. Well, on our home page, we always comment on the most recent significant United States economic factors and developments. That is U.S. economic news. And to the right of that, we'll always provide a chart that relates to that significant factor in development. I mean, this chart is on existing home sales. Why? Because that's the article to the left where we discuss existing home sales in the U.S. economy. Next, below that, we on a regular basis, not necessarily a daily basis, because if there's not any significant economic news released on a given day, but we don't just go out and find some insignificant economic news just to provide you with some useless daily information. We only report and comment on important factors and developments. That are factors and developments that are likely to affect the financial markets and your financial market portfolios. So first, U.S. economic news and a chart of that. And here up to the above that, you'll see a menu item regarding that reads our Econ Monitor, and you'll see if you put your mouse over that, then there's Econ News, and to the right is U.S. Econ News and International Economic News. And we'll click on this first one, U.S. Economic News, and what you'll see going back, I think approximately a year, when we started providing a lot more information at our internet website, you'll see bullet points regarding those U.S. economic factors and developments. Going back to June of 15 is when we really started putting a lot more information on our website. And you can click on any of those, and here let's click back here, for example, because we have the U.S. existing home sales declined for second consecutive month. I see I got an F after the word for, so I'm going to correct that spelling. So that's already on our home page on September 23rd of 2016, which is, by the way, when I'm recording this video, and we'll update this video periodically whenever we feel a need to. But let's just put our mouse over this 9/20 of September 20th of 2016 building permits for new housing starts, and you can read about that. And give it time to appear, to load. I'm on the internet right now. I'm recording this video by actually being on our internet website, and you can read any of these articles, and you'll find very, very quickly our articles tend to be fairly short. And why? Because we don't go on and on about unimportant information. We don't provide quotes from 2 to 3 or more persons at stock brokerage firms that often have ulterior motives in their comments on certain factors and developments. We just provide you important fact-based information, and then you can decide for yourself whether or not you think that's important or not. So let's go back to our home page. So on our home page, which we update regularly with new important information. Once again, U.S. economic news on important factors and developments, a chart that relates to those factors and developments, and then below that we have international economic news. And you'll notice, those of you that do go out to our website regularly, we focus on internationally the Eurozone, Japan, China, Brazil, and India. And the reason being that those regions of the world and those countries are the largest regions and countries of the world in terms of their economic output of goods and services, their gross domestic product, their GDP. The U.S. is the world's largest economy, followed by the Eurozone, followed by China. Depending on how you measure GDP, sometimes China, sometimes Japan, but China and Japan are real close, and then Brazil and India are next in line. And once again, depending on how one measures GDP, whether Brazil and India is really 5th or 6th in terms of gross domestic product. So, and you can see here, you can click to continue reading this article. Next to that, we provide on a daily basis earnings news, and we tend to focus on large and or closely followed companies rather than commenting on 5, 10, 15, 20 different companies. But if you want to be kept abreast of the latest quarterly earnings announcements from any large, closely followed company. We're not necessarily on tiny companies. All you need to do is click here on our calendar of Q2 earnings, which is the most recent earnings calendar as of September 23rd, 2016. And you'll notice when this page loads that the latest earnings results that we provided for the second quarter of 2016 was August 10th, 2016. And the reason being is there were no large companies that reported their calendar quarter earnings after August 10th. Now, there are companies that have fiscal quarterly dates that differ from those calendar dates, but on this page we just have information on calendar quarter sales and earning. And we don't, if you notice here, we don't have anything regarding whether or not a company beat Wall Street so-called analyst earnings estimates. Why? Because we don't care whether they beat those earnings estimates or not. And then some of you are probably thinking immediately, what do you mean you don't care? I mean, that's very, very important. No, it's not important. It's usually important for a few hours to maybe a couple of days, but that's it. And the reason being, I have found in more than 25 years of investing, speculating, and trading in the financial markets is that these Wall Street analysts, these sell-side analysts, these analysts at these brokerage firms, those are the folks that the general news media is referring to when they say whether or not a given company beat the analyst estimates. Well, these guys, almost without fail, they strive very, very hard. Well, at least I can't prove this, but in my experience, extremely strongly indicates that what they appear to try to do is to always, make sure that their estimates are below what the company actually reports. And why? Well, very simple. Then there can be some big news story on how, Flower Foods or Kelly Services, I'm just going down here, or Shake Shack or Wendy's beat analyst estimates. We don't care whether they beat those analyst estimates. As an analogy, let's say there's a professional basketball team that has a professional basketball player on their team that normally scores 6 points a game. That's what the person normally scores. And let's say that person then had a game where he scored 8 points instead of 6. Then there might be some big announcement how so-and-so, wow, he had a great game. He did much better than what he was expected to be. Well, the fact of the matter is, if he still scored only 8 points, that's not many points. That doesn't mean, he's a good scorer. So we don't focus on whether or not a company beat analyst estimates. What we do instead is we compare the most recent quarterly earnings per share to the earnings per share a year ago. And were they higher or lower? Because that's what really matters. Is a company growing? Is it increasing its earnings versus a year ago? Or are their earnings decreasing? And we also provide information on revenues versus a year ago. Are they improving or are they worsening? Okay, let's go back to our home page. Enough about that. I give that a moment to load. So back to our home page. So we, on a regular basis, one more time, we provide the most recent significant U.S. economic news, a chart of that, or that relates to that news, international economic news, the most recent significant. And let's say you're watching this, happen to watch this video, 3 months from now, during December, during December of this year. Once again, we're recording this video on September 23rd of 2016. So, our website will have the current information whenever you're watching it as opposed to what we're seeing right now. So, U.S. economic factors and developments, U.S. economic news, international economic news, earnings news. Then we come down, geopolitical news. Now, what I have also found, the geopolitical factors and developments, they tend to affect stock prices at least, and really prices of bonds, commodities, precious metals. They tend, real estate, to affect securities prices only generally on a very, very short period of time. They're really not very important except for a day or two generally. But still, we do think that it's important to keep up with significant geopolitical factors and developments, because there are times they can have longer term important effect on the financial markets. And then on a weekly basis, every Sunday, we provide some comments. These are our personal comments on just the general trading action in the financial markets. And then below that, on a daily basis, we provide company news, and generally only on 3 to 5 companies, because we only provide company news on large and or closely followed companies. You'll see this here. Everyone knows Apple. Everyone knows Twitter, Carnival Corporation, a big cruise line. And then below that, then we provide also some information on the most two prior significant U.S. economic factors and developments. So that's our home page. So now let's come back up here, and you'll see our burgundy colored menu bar. We have information on economic factors and developments, once again, both U.S. and international, because economic factors and developments are very, very important. Those factors and developments tend to have the most impact on the financial markets. Our geopolitical monitor provides information on important geopolitical developments. And see, all of this, of course, is on our home page, but on our home page are only the most recent important factors and developments, whether they be geopolitical or economic. But the buttons you can click on here will provide you, well, we'll click on the geopolitical news like we did a few minutes ago with the U.S. Econ News. We'll provide you with archives of past factors and developments, and you might want to click on these. It might be something important that you missed. Let's go back to the home page, and when I'm getting ready to click back to the home page, you'll notice that we really don't need, unlike most websites, to use our back button or go back to our home page. And the reason being, I'm scrolling down, you'll notice that on our site, our menu bars stay intact regardless of how much you scroll down. So you don't need to click the back button or go back to the home page. Having said that, let's now take a look at the earnings monitor. Well, we provide on a regular basis, once again, news on large, closely followed companies, and we'll wait for that to load. But on September 23rd, the Finish Line announced its fiscal second quarter corporate operating results. But you can scroll down this and you'll see that, you know, we provide a lot of information on corporate earnings announcement. That's so-called earnings news. It's not just earnings news, it's also revenue news. I'm going to click the home buttons just so we don't get confused with these other pages in what I'm going over here. So, once again, well, of course, economic factors and developments affect the financial markets. Geopolitical factors and developments tend to have some impact on the financial markets, but during usually a pretty short period of time. Earnings monitor, of course, corporate operating results affect the financial markets. Here, again, you can put your mouse over earnings results, and that'll take you back to the tables of quarterly earnings results. And by the way, let's say, I don't know what browser you're using, but I encourage you to, if you don't already know how to use define link or button or element for your browser, find out. I encourage you to do so. Right now, we're doing this video using Google Chrome, and over here, these three little bars are up right hand corner. If you click on that, you can then come over and find that find feature, and other browsers allow you to do that. And then down here on the bottom left hand corner, find and page, let's just type in, I don't really care. It's pretty much any large closely followed company. you're going to be taken directly to their most recent quarterly results. So let's type in General Motors. Whoops, got to spell it right. General Motors. And there it is. They'll take you directly to General Motors, to their most recent quarterly earnings and revenues results. Okay, we'll go back to the home button, even though we don't really have to go back to the home page. So why am I talking about economic factors and developments, geopolitical factors and developments, earnings releases, corporate operating results? Why am I talking about this? I'm talking about this because these are the factors and developments that matter. A lot of these, I said earlier that in the general news media, as well as the general financial news media, you'll hear these guys talk about a lot of things that just aren't significant. Secondly, I commented early in this presentation how we're a top-down, we use a top-down approach to analyzing the financial markets, forecasting future developments in the financial markets, and to determining which asset classes and economic sectors, as well as individual securities, that we invest and that we recommend that our paying subscribers and clients invest and speculate during any point in time. Now, some of you might be thinking, well, wait a minute. Yeah, why do you do that? My advisors, it's claimed over the years that no one can time the market. So why are you bothering to do this? Isn't that true? Come on, nobody can time the market. Well, here's what I have to say regarding that. Whenever you hear someone tell you that person says, well, no one can time the market, here is what I would argue is that person is really saying. And that is the person that's telling you that is saying that he or she can't time the market, that they're unsuccessful in timing their market. They're not able to do that. Well, my response to be, why would you listen to that person if they're unable to time the market? Because getting in and out of the right asset classic and sectors and industries and individual securities at the right time is extremely important. It's very important to avoid these big downturns in the financial markets. And I'll show you why in a few minutes, why that's important, if it isn't already self-explanatory. But of course, a lot of these folks that are so-called advisors, a lot of them are actually asset gatherers. They're not really advisors. They don't really necessarily know about the markets. They claim on the regular basis nobody can time the market. Well, I have a question for you then, something I'm about to show you. Well, you're going to have to convince me of that, because I'm going to show you something here. I'm going to scroll down toward the bottom of our website, and I'm going to click here on this right here, this end, the word end. And for some reason why, I don't know why, but when we click on that, it'll take you back to the top of our site. So then I'm going to ask you now, or we're going to scroll down again. In other words, when I say I'm going to ask you, you can do this on your own at any time after you finish watching this video. If you scroll down again, I'm going to take you to here. Articles written by David Frazier, that's me, for moneynews.com, an internet website that is a site provided by Newsmax Media, which is a general news as well as financial news provider. And at one time I was employed by that firm, and I wrote a lot of articles for this firm and did numerous other things for the firm. But you'll see if you click here, financial, economic, and investment articles written by me, David M. Frazier, from June 7th to December 2011, when I left the Newsmax Media and formed my own firm. If we click on that click here, you'll see this takes even a minute or more to load, so bear with. Oh, it didn't take too long. And now this takes you to Newsmax's website. This is not my site. This is a different site. Okay? If we then click on, let's see, August of 2007, okay, a lot of you might know, some of you do know instantly, that stock prices peaked, at least the major market indices around the globe, during October 2007, and the major U.S. stock market indices peaked on October 10th, 2007. Well, if you scroll down this page on this Newsmax site, you'll see that on August 10th, 2007, here's an article that I wrote, Markets on the Verge of a Plunge. Now you can click on that once you finish this video, and you can read that article and how I told you why my research and analysis indicated that markets were on the verge of a plunge. That was actually the day that stocks did peak. But at that point in time, I nor no one else in the world knew that that was going to be the peak in the markets. I just literally just now realized that. I actually wrote that on the day that the major U.S. What am I talking about? I'm back up here. Now I'm getting confused. Markets did not peak till October 10th, 2007. I'm sorry. I got a little too excited here. But I told people on August 10th, 2007, which is 2 months before the actual peak, that markets were on the verge of a plunge. If we go up a bit, we'll see on August 14th, I then wrote another article. I said stock prices headed lower. And then if we click the, I'm going to scroll down here if I can. If you then go back and read several other articles that I wrote during September 2007 and October 2007, you'll see that I continue to warn financial market investors and speculators that stocks were probably headed lower. And I'll pull something out here, very important. Let's see, I need to go to September 2007. No, let's use October. October 2nd. Here's something that I wrote right here. Economic slowdown almost certain. Almost certain. You can read that article on your own. Several other articles up here. Corporate profit estimates paint an ugly picture. We go at some more. Dismal retail sales point to falling stocks. So don't tell me that no one can time the market. And I've got a lot of other documented documentation of me not only warning people to get out of the markets during August, September, and early October of 2007, but them to actually put their money in inverse equity funds, exchange traded funds that move in the opposite direction of the major stock market indices. While I'm talking here, I'm going to click a bit to get back to our home page. Actually, I'm going to leave it there for a moment. Let's not focus on that on your screen right now, but I want you to just listen, if you will, please, for a moment. And we people who followed my advice, and I'm not trying to be braggadocious here. I mean, trust me, I make mistakes in the financial markets. I lose money in stocks. I don't always get it right, but I've been right a lot more often than I've been wrong about the overall markets, economic developments, and individual securities. I don't want to hear about no one can time the market. I mean, I've been very successful at timing the market, and I don't mean on a daily basis or a weekly basis, but going back to January of 2000, my models have accurately timed the market, the U.S. stock market, within 3 months of peaks and bottoms in the major stock market indices. I mean, I have documentation to support that. But now, of course, there's some of you going to probably think immediately, like a stockbroker that I ran into about a year ago, say, but did you get people back in the market? You continued to stay out. Well, guess what? That's not true. And if you read an article that I wrote here during 2009, during February 2009, I'm going to show you that right here, February 3rd, 2009, stock range bound for now, then will rise. February 17th, 2009, buy stocks now while they're down. And if we go to October, that's February 2009, only a few weeks before the 2008 to 2009 bear market ended and a new bull market began. If we then go back We've got to click on 2009 again and click on March of 2009. The major stock market indices bottomed on March 9th, 2009, and only a couple of weeks after that, on March 23rd, I told everyone that read this, new bull market here, buy before it's too late. So, no, it's not true that no one can time the market. We here at Fraser Mayer Research, LLC, the providers of Investors Monitor, have been very good at timing major turns in the financial markets. Once again, we don't claim to get everything right or to get the day or the week, but we've been very good at timing major turning points in the market and helping people that listen to us and that go to our internet website and subscribe to our relatively low fee investment journals. We've been very, very good at helping people do exactly what I stated early on in this video, and that is to avoid the big downturns and profit from the major upturns in the worldwide financial markets, and to get in and out of the right sectors at the right time. Okay, enough about that. Let's go back to our site. So we've covered our homepage. I've shown you what's on, our Econ Monitor, economic news around the U.S. and around the world, geopolitical monitor, earnings monitor, timing monitor. Now, our timing monitor provides information on first the current investment environment, and I update this every Sunday that will give you some quick comments on the current investment environment. Once again, I'm doing this video I'm actually recording this video, I think I said earlier, on September 23rd. I'm actually recording this video on Monday, September 20. Boy, what is today's date? The 26th. So the screenshots that I showed you were on our homepage. Were all from the previous Friday, on that is September 23rd. But this page of our website, the investment environment page, we update as it reads here every Sunday, and that was what I'm showing you for an example here, September 25th of 2016. The overall environment, the fundamental environment, and also the short-term trading environment. And if you go back up here on the burgundy menu bar under timing again, you can also, if you put your mouse over investment environment and then move it over to investment environment rating, we give a rating that we update daily from a scale of 1 to 10 of whether or not we think it's a wise time to invest and speculate in the financial markets, or whether it's a good time to do so or a really bad time to do so. And if we consider the investment environment to be very, very negative, and that you should therefore primarily be in cash-like securities, whether it's money markets or CDs, and maybe some limited number of fixed income securities that have little price risk. Well, if it's a time to be mostly out of stocks, that is, this investment environment rating is going to be really low. The lowest it can possibly be is 0, and the highest is a 10. And on September 25th, 2016, we're saying it's a 3.5. It's extremely low, meaning it's a dangerous time to be in the markets. So there's our one of our timing pages. We also provide archives. If you put your mouse on this stock trading action, it'll give you archives of our well, let's go back to the home page. I know I'm jumping around here, but try to keep up, and keep in mind you can pause this video at any time. You can come back to it. So I'm just trying to cover things the best I can in hopefully about 50 minutes, less than an hour at least. So we're on the timing monitor. So we can, if you scroll down, this trading action on our home page, we update that every Sunday. But if you put your mouse back up under this timing monitor and were to click on that stock trading action, you'll see archives of that. In fact, I'll do it. I'm going to click on that, and you'll see we only started providing this very, very recently, as of September 26th. When we're providing this video, very, very recently, but you can click on archives and what we wrote about previously. We'll go back to our home page again. And then we provide information on our timing monitor on our buy-sell index, which is very, very important. I'm going to come back to that towards the end. I'm going to move a little faster now because we're getting rather long in this video. A very, very important market timing indicator. Sector performance, another very important market timing indicator. Our relative price strength index, another one, and our overbought, oversold indicator. Or you can click on technical indicators. If you put your mouse over it, you'll see some major ones. But if you were to click on it, which I'm doing now, you can then come over, or then you'll land on a page that you can click on any of these so-called technical indicators. That is, that reveal the recent trading action in financial markets. And a lot of you are familiar with this. The Association of Individual Investors, Investor Sentiment Index, a percentage of investors who are bullish. State Street, Investor Confidence Index. The New York Stock Exchange Cumulative Advanced Decline Line. If you were to click on that, you'll get a chart of that, and that can keep you updated with the trading action in the markets. Let's see. I'm waiting for that page to load. You can click on those at any time. Go back to our home page. As of September 23rd during late September, I am going to click on one more of those. That is on those technical indicators. And you'll see that it's very interesting that these folks at these big so-called wealth management firms, stock brokerage firms, you know who they are. For the most part, they're trying to claim everything's okay. You should stay in the market, just like they did during late 2007, claiming no one can time the market. But let's look at what these folks are actually doing. I'm going to click on the State Street Confidence Index. And this is not an actual sentiment indicator. State Street, which is involved in doing work for thousands of institutional investment funds around the world, whether they be endowment funds or mutual funds or insurance company funds. They actually monitor the allocations, the investment allocations of those big institutional investors to get a read on what are they actually doing, not telling people. And take a look at this chart for the State Street Confidence Index as of August 31st, 2016. State Street only provides data on these allocations on a monthly basis, and then I create a chart of it. Look what they've been doing. This chart is going to basically tell you whether when it's rising, it essentially means that these institutional investors are putting more and more of their investment funds into cyclical stocks and growth stocks. Stocks that perform well when economies around the globe are performing well. And they do just the opposite. They reduce those holdings of growth and cyclical stocks when they see danger ahead in the worldwide economic environment, and they put more of their money in so-called defensive stocks. Consumer staple stocks such as Procter & Gamble, stocks of companies that provide goods and or services that people use on a regular basis regardless of the economic environment. And look what they were doing during, really over several months leading up to August 31st. They were reducing their holdings in cyclical and growth stocks and adding to so-called defensive stocks. Well, that's very, very interesting. They're telling their shareholders and clients that everything's fine, yet, boy, they've been getting out of growth and cyclical stocks. So all this information that we provide is very, very important. I'm going to speed up quite a bit now because we're getting close to 50 minutes. I really don't want this to be over 50 minutes. A lot of people lose interest, and oftentimes tend to get bored after more than about 50 minutes, and that's why I'm trying to keep it to 50 minutes. But we also have over here, that's our general news buttons, and we'll provide the same news information on important factors and developments, and generally referred to as news, but not emotional and significant, only important factors of development. It's just another way to access our news instead of going in to the specific econ news or into the geopolitical news or into the earnings news. So you can click on that and explore that if you'd like. Then in stocks, well, very, very important. Why stocks way over here to the right? Once again, because we're top-down investors. We approach the markets from a top-down perspective. We look first at the overall economic factors and developments, to some extent geopolitical factors and developments. That leads us into certain sectors and industries. And then we go in and look at individual earnings of companies. And then finally we get to which stocks we think make sense. And we're not going to tell you for free which stocks to invest in. I mean, my gosh, we got to get paid somehow for our services, but we will tell you which stocks to invest in and speculate in if you choose to subscribe to one of our investment advisory journals. But what we do provide you with some important information on one of our stock pages. You can look at stock news, stock articles that we've written in the past. We haven't written some for quite some time, although we hope to start doing that again. But if you put your mouse over to stock recommendations, it's not outright recommendations. You got to pay us a little bit of money through one of our advisory journals for our specific recommendations. But we do provide information on candidates, stocks that we're looking at, and really that we might be telling our people to put their money in right now. But we may just be monitored very closely. By the way, this first one, Ambarella, we had recommended this back in a couple times during the past few years. The most recent time that we recommended buying it was in, I think it was January of 2016, when it was in the low 30s, around $33, $34, $35 a share. As of September 23rd, of 2016 is around $65 a share, and we had told people actually get out of that stock. I think it was early September or late August of 2016 when it was around $63 a share. It previously had an overall A rating, but now we have a C rating on it, primarily because our PEG ratio, our price to earnings growth ratio, we're showing that financial market participants are overvaluing the stock. And so you can go through and look on this page on your own, and send us an email or call us if you have questions about this page or any other information. So we're going to click on the home button again, even though we don't really need to, but I don't want you to be confused by any of these individual pages here. And so this is what we provide on our site: economic factors and developments, geopolitical factors and development, corporate earnings factors and developments, earnings results, timing information, what's going on, what's the trading action, information on individual stocks. Here's the chart of the week. You can click on that and explore that on your own. We put a chart up every week and comment on that chart and give you an analysis of what that chart is telling us. We also have a TV show. It's an internet TV show that we haven't recorded for many months now. Now, I think the last one, well, you can look here, it was back in January of this year. Actually, you can't. Well, yeah, you can. On this video, the last one that we recorded was January, so we haven't recorded any of those internet TV shows recently, and because we've been focusing on more important things and really on improving our website. And but that's no longer going to be provided for free. But if you subscribe to it, I'm going to click on that now, our investment advisory journals, and what is most suited for individual financial market investors, speculators, not traders really. We do have a service for that. I'm going to scroll down. That's our buy 10% in 30 days. It's a trading service. But for most folks, what's most suitable, we believe, is for individual investors, is our monthly journal, where we also provide trade alerts anytime in between those monthly publications, as well as our weekly commentary, which we provide for free for a certain period of time, but then is always a part of what we also offer for our for Fraser Strategic Allocator Service. And you can click here for sample journals and take a look at those and see if that's something that might interest you. You can click here, very, very importantly, if you click on the free trial, and you can subscribe to that service for a period of 60 days at absolutely no charge. You'll get our monthly publication. You'll get any trade alerts that we issue in between the monthly publications. You'll get our weekly commentary, which is free on its own for a period of 2 months, simply by putting in your name and email address. And you're not going to need to provide some credit card like most of these firms do. All you need to provide us is your name and your email address. And I'm going to wrap this up by saying I was going to go back and show you my face again, but we're running out of time here, and I don't even know if you really need to see my face anyway. But we're going to go back here now to, if you put your mouse over Timing Monitor, and then come down to see Buy Sell Index and click on that. Some of you that are past clients and subscribers to our services, you're really familiar with this. But this is our Buy Sell Index. Here we show it in chart form of the readings on our tactical asset and sector allocation model. You can look at this on your own going back to 1996. You'll tell people when we were saying, hey, you need to get out of the market, and hey, we ended up buying higher. That is telling them to get back in at a higher price. But we ended up telling them to get back out at even a higher price. And then buy, sell. You can look at this on your own. Most importantly, you'll find that we told people during, I think it was September, is when we told our clients and subscribers to get completely out of stocks. And you see what happened to stock prices. This black line is a line of the S&P 500 index. And you can explore this on your own. Send us an email if you have any questions. But here's how I want to wrap this up. Remember, I make comments on this on every week. But if you go back up towards the top of here and you want to see a long-term chart of that, you'll see how, I created our tactical asset and sector allocation model during 1986, and I back tested it to 1969, and then I've used it since then and tweaked it here and there in real life scenarios, not just back testing. But if you scroll down here, you can look at the long-term performance and how the S&P 500 responded in relation to the readings on our tactical asset and sector allocation model and our related buy-sell index. But more importantly, remember, a lot of these folks out there, these so-called experts, they always tell people how no one can time the market. Well, I think I've shown you. And if you subscribe to our services, I'm really not trying to sell you that, by the way. I'm really trying to show you how to use this website to keep up with important factors and developments. But I'm going to come back to that in just a moment. But as far as no one timing the market, well, here you'll see a chart of if you had used our tactical asset market timing approach as opposed to a buy and hold strategy that is staying in at all times because no one can supposedly time the market. Well, you can see the performance results here. You can read these on your own when you have the time. But if you had put, for example, $10,000 on just one time and never added to it, $10,000 in the U.S. Stock market overall, a diverse portfolio, I'm using the S&P 500 index, one-time $10,000 investment during December of 1969. At the end of 2014, I'm sorry I haven't updated this chart since then for the year 2015, but at the end of 2015, if you'd used a buy and hold strategy, you would have that $10,000 would have turned into $885,000, a little over that. But if you used our tactical asset and allocation strategy, it is getting in and out of the markets near the peaks, near the highs, it would be almost twice that. It would be $1.5 million that $10,000 one-time only investment would have turned into. And if you had instead gotten in and out of Let's see here. I don't know. I have a chart of that was updated during 2011. I know why I have this. You scroll further, which another chart that I have not updated. Unfortunately, I will now since 2011. If you had instead gone into small cap growth stocks, not even really small caps. I take that back. This is actually tracking a growth fund. I think it is a small cap growth fund. I think it's a Value Line small cap growth fund. But I have the details down here somewhere. Anyway, if you'd instead not join into a large cap S&P 500 type of index, near the highs, near the bottoms, this is at the end of 2011. At that point, a buy and hold strategy would be worth $500,000 from a $10,000 one-time investment during December of 1969. It would have been 4 times that amount of money. So getting in and out of the markets during key times, during near these tops and bottoms is very important, and we've been very, very good at it. So I'm going to wrap this up by saying, once again, our integral sign. Everything is integrated. It's because it's related. There is economic factors in development, geopolitical, corporate earnings results, the short-term trading. Everything's integrated, and that's what we try to provide to you. And our website is integrated too. And how is it integrated? But if you can just come to our site on a regular basis and not pay us for anything, and you can keep up with the markets and important factors and developments, and we're completely okay with that. Or you can integrate that even more by subscribing to one of our journals. What's most suited for individuals, once again, is our Fraser Strategic Allocator, and we will keep you updated on weekly factors and developments, and you can integrate that monthly journal with our weekly market commentary, and it's also integrated with what's provided on our internet website on a daily basis. It's all integrated. So it's been a long video. It looks like we've gone a little bit over that 50 minutes. I apologize for that, but I really sincerely encourage and really hope that you use our website on a regular basis. And even if you don't subscribe to one of our journals, make this into a tool. Use this to keep up with important factors and developments in the financial markets. In other words, use this to monitor the market. And that's what we're called. Not just the market, but factors and developments that are likely to affect the financial markets and the value of your financial market portfolio. So I thank you for listening. And that's all for now. Send us an email if you have any questions or comments. Thanks again. That's it.